Hi everyone, thanks for coming. My name is Robbie. I'm a second year at Kellogg. I'm excited to introduce our panel today and our moderator, Brian O'Connor. He's a managing partner at NextGen Growth Partners. He's also adjunct professor at Booth. Prior to NextGen, he bought a company through a search fund and exited to a strategic buyer. But I'll hand it off to Brian. Thanks, Brian.
Great. Thank you, Robbie. So it's an honor and a pleasure to be here. I'm actually calling this room the Big Kid ETA. So the other track is for smaller, less experienced operators than we have in this room. So it's a pleasure to be here. I have the honor of introducing this highly distinguished panel. Mark Anderegg, CEO of Little Sprouts. Jake Petoskey, principal at ParkerGale. Chris Lueck, CEO of FastSpring, and last but not least, Haley Beck, investment professional at Alpine Investors. Can we please give them a round of applause for sharing their time? So where I'd like to start is maybe if we just go down the line, starting with you, Mark, maybe share a little bit about your role or your firm, and specifically how it contemplates operating, and where maybe you're not the CEO. Mark, I know you are the CEO, but where maybe you're not, how that sort of fits into operating in the broader ETA context.
Yeah, certainly happy to do so, and I'd invite you to redirect if it's not responsive to how you envision this prompt going. So first, I just want to share a detail about my current role that maybe isn't as clear in the bios, because it actually factors into how I think about my role as CEO. So Little Sprouts was acquired a few months ago by a French strategic company. So I now am the CEO of the U.S. business for that company. But it's a different dynamic, sort of reporting to operating folks in Paris versus reporting to private equity sponsors in New York. So the evolution has been an interesting one. First as CEO, reporting to a board comprised of a diverse group of search fund shareholders, then to a consolidated private equity sponsor, and now to, again, a strategic. So how do I think about my role as CEO? So, I remain reasonably autonomous within that construct, and I'm responsible for all of our U.S. operations, and I report up to the CEO of the group in Paris. Am I giving you enough to go on there? Okay, right on.
That's great. Yeah. Perfect. Thanks, Jake.
Great. Thanks. I'm Jake Petoskey with ParkerGale Capital. We're a B2B software-focused, lower middle market private equity firm. Typical profile of a deal for us is 10 to 25 million in revenue, profitable, like to be the first institutional capital in, and specifically where the founder is looking to transition out. So we typically bring in our own CEO and augment the management team. I work on an operating partner team, so there's 4 of us within ParkerGale that spend 80% of our time focused on working with the portfolio companies and the portfolio company management teams post-close on the operating initiatives that we think are going to drive enterprise value for the business over the 3 to 5 years that we're in the deal. So in terms of our focus, we focus on talent. So building a talent management program, pushing that down into the companies. We think there's real value in the sort of middle 60% of a company, and to bring some of the B players up and grow them into potential executive roles is, that's a value creation lever. We focus on product. We focus on systems, so back office systems, making sure that, again, these are typically founder-owned companies that are running on Microsoft Excel, QuickBooks, so moving them onto sort of enterprise platform. And then we focus on growth, so sales and marketing, related initiatives. And so we like to get engaged early and set the operating cadence and operating rhythm for how we work with management teams. And in the first 100 days, everybody's heard of 100-day plans. We like to sort of be very prescriptive, working collaboratively with management teams around, here was our thesis and diligence around the 3 to 5 things that we think we can do during the course of the investment period, and if we execute on them, we'll return 3 times our money. So putting together that prescriptive plan and then working with the management teams, over the course of the investment on, how are we tracking relative to that plan and sort of adjusting things over time. That's one of the areas that I primarily focus on.
And so similar to Mark, let me know if I'm veering off, but so Chris Lueck, I'm the CEO for FastSpring. We're an e-commerce software platform that makes it easy to sell software and other digital products online around the world. So just a quick example, our customers are software developers that make things like photography software, and they use FastSpring to power their e-commerce systems on their websites. So I acquired FastSpring in early 2013 through a traditional search fund model, and then we just exited to a private equity firm, Excel KKR, in February of this year. And so having gone from an ownership structure under the search fund model where my largest owner was probably 15% of the company to now one large private equity fund that owns 80% of the company, it's a bit of a change, but a good one. And before I think I had a lot more autonomy than I do as a CEO under a PE fund that owns a significant majority of the company. Different aspects, but there's positives in both cases.
Good political answer, Chris. Thanks. Haley.
Hi, I'm Haley Beck, and I'm on the investing team of Alpine Investors. We're a Bay Area private equity firm. We've been around since 2001. We're currently investing out of our 6th fund and raising our 7th fund. And where I fit into this on the investing side is working on deals and ultimately finding the deal opportunities that we put in our CEO every time. Much like ParkerGale, we focus on software, B2B business services, and then also multi-site healthcare. And one thing that's unique about Alpine, we have a CEO and training program where we hire exclusively out of MBA programs and look to put post-MBA folks either in a CEO position or in a platform company as kind of, a C-level person. So I've worked closely with over, I think now around 10 to 12 of our CEOs in training and helping them find deals and put them in deal opportunities. So that's a little bit about Alpine and where I fit in.
Yeah, thanks, Haley. And maybe it makes sense it's a good segue into my next question, and if we can, stay with you on this. So the search fund model that Mark and Chris pursued has a pretty well-defined blueprint, right? You search for a business, you structure the acquisition, and then you generally will insert yourself as the CEO. How does Alpine, and then maybe Jake, you can comment on this as well through ParkerGale's lens, but how do you think about the different flavors of operating the business? Because it sounds like you have this CEO and training program. You do sometimes back CEOs that are focused potentially on a specific thesis. How many different flavors are there within the model that you guys adhere to at Alpine?
Yeah, so a couple different flavors. In every situation, our sourcing team finds the deals and our investing team does the diligence. From the operations perspective, 100% of the time we're looking for management transitions. And those transitions could look like putting in a CEO in training as CEO on day one. They could look like putting in a more experienced kind of seasoned CEO in residence and adding CEOs in training to the C-level and having CEOs in training kind of start at the C-level and then in the next deal become CEO. Those are kind of the different flavors, but 100% of the time looking for transitions. And then in some situations, CEOs in training, as they go through the matching process, none of the deals that we currently have in our pipeline are interesting or exciting. And so they'll be in residence for a period of time, evaluating deals alongside our investing team and alongside our sourcing team to find something in a geography, in a industry that's exciting to them.
Jake, any similarities or differences at ParkerGale?
Yeah, I would say we don't have a formal CEO and training program. I think it's a really interesting concept. We do have, and within our sort of executive network, we've got a select number of folks that we will work on a dedicated thesis, whether it's education software, something in the legal space. So we will work with that executive to build the thesis out. And then, go and try to find a deal.
Sure. Shifting gears a little bit, Mark and Chris, you've both recently been through changes in capital structure. Mark, twice now in the last 12 to 24 months?
Yeah, yeah, a little over 2 years.
Yeah, so how has your role as CEO evolved? Chris, maybe the less political answer if you can. But how has that role evolved through now, Mark, who you've been through the process with first a financial buyer and then a strategic buyer. Talk to us about the evolution of your role as CEO through those transitions, and then maybe Chris, similar commentary on your sale to a financial buyer.
Yeah, happy to. So I guess I would observe first that more so than the capital structure, the scale of the business has yielded more of a shift in my role as CEO. So as we've scaled, I've found that my role as CEO has become less tactical and more strategic, and certainly with a greater emphasis on building out a real people infrastructure in the organization. So that's, I think, the most meaningful evolution that I've experienced. With respect to managing the capital structure, the dynamics are different, but not maybe as significantly as it could appear. So going from the diverse search fund shareholder board to a majority-owned private equity sponsor was actually rather similar. We would still have the quarterly board meetings. I'd say the level of engagement was comparable, and I actually did not observe any compromise in degree of autonomy that was bestowed upon me. This most recent shift to a strategic owner, I'd say has been a more significant departure. So I now am accountable to folks that operate within our industry. So to their credit, they have a better sense for the KPIs and what good looks like. So I would maybe frame it that I feel more challenged now than I did previously. But like authentically, and this actually is not the political answer, it's just the truth. I've appreciated the fact that I'm now being challenged by folks that actually really understand the drivers of the business.
Sure.
Yeah, and then so for me, I guess just one point. It's interesting that I actually feel more like an owner now than I did previously as a search fund CEO, because as a search fund CEO, I was still vesting my equity. I still had this stack of preferred equity ahead of me. And now with the transaction with KKR, I have preferred equity. It's the same class that they have. So much more aligned with them and do feel more of an owner in that regard. But the shift for me from search fund CEO to private equity CEO, it's a learning curve. I mean, there's a lot more reporting. I have a weekly call with them. We brought on an outside board member. He and I have a one-on-one. We have a monthly financial call. We have a quarterly board meeting. They have a consulting group that I brought in one of the people from the consulting group as our interim head of product management. So they're very involved in the company. And ultimately, it's helpful. But it certainly takes a change from where you had a lot more, like I said earlier, more autonomy under the search fund model than under a private equity owner. And again, pluses and minuses on both sides, but it takes a little bit of a challenge. I'd say under the search fund, we kind of went through adolescence, and now with the private equity owner, we're starting to have to grow up and continue to improve our processes and reporting that we had put in place, but it's another level that we need to get to now.
Any operator who's lived through a transaction can appreciate the changes and the additional work. Sometimes it's accretive, and other times maybe that's less clear how accretive it is. But yeah.
Can I add just one thing?
Please.
Chris jogged a thought for me. So I recall being a first-time CEO with a search fund board that I felt kind of nurtured and invested in, and it wasn't expected that I actually knew what to do, which was true. However, when we sold just 2.5 years later to a private equity firm, I got the sense that they were like, oh, yeah, so you are a CEO, like you are officially a CEO now. We don't expect to need to train you or to develop you. It's like, go run the business and deliver the results. And I actually appreciated that, and I thought it was a positive shift, but very different in terms of, I guess, maybe just expectations.
Yeah.
Yeah, and one thing I was joking with Mark earlier, so they'll sometimes say to me, hey, so we think you should do X. You're the CEO, so it's your vision, but we think you should do X. And that's code for do it or it's going to get done anyway.
So that actually brings up a really interesting point that I'd like to get Jake and Haley's perspective on. So there are a lot of areas of the business that a CEO can focus on, right? There are so many different hats that a CEO can wear. Where do you like to see your CEOs focus the majority of their time, or what are the key buckets? There's people, there's customers, there's product or service, there's investor and board relations. There's all these things, right, that are conflicting, that are competing, I should say, for a CEO's time. From your perspective, where do you like to see your CEOs allocating time and attention?
Yeah, I would say where you typically see, especially a first-time CEO, spend their time, 80% of their time is spent on making day-to-day decisions, looking at reporting, so day-to-day tactical things like helping to negotiate a deal or a contract. We think those are generally lower value add. I think generally CEOs should be spending 50% of their time thinking about solving larger strategic issues. For example, where is the next growth opportunity in our market? It's spending time with customers and understanding, how our product or service, fits into, addresses their pain points. What else could we think about selling them? 40% of their time, I think, would be focused on sort of coaching and developing the folks below, the second level folks below them. So, one-on-ones, sort of dedicated coaching efforts to bring those folks up the curve. And then really 5 to 10% of their time focused on the day-to-day tactical things, getting involved in a customer, a very large customer negotiation if needed, but that should be stuff that's done more or less by exception. So that's sort of the mix I think we typically think is successful.
I think that sounds great. I want to go work for a ParkerGale because you don't have to do any shareholder relations. This is awesome.
Haley, anything to add to that or anything different that you think about at Alpine?
I think it's similar, and I think a little bit of it just depends on the business and where it's at in its growth cycle. And so at Alpine, we kind of bucket it into 7 different levers that you can pull in any business. There are things like talent and team. There are things like pricing, product market expansion, all these different things. And then, we encourage our CEOs and operators to think about, for this quarter, for this year, what are the 1 or 2 levers that I'm going to pull in this business that are going to have the biggest impact, and then kind of focusing on that. We think that there's a lot of power in focus and not spreading yourself too thin, but doing, 1 or 2 big things this year really, really well.
Okay, so let's stay with Jake and Haley for a second. How do you measure if it's going well? If those things that you think your CEO partners should be focused on, how do you sort of step back and say, this is moving in the right direction? I mean, is it, we can all sort of evaluate the financial statements and see sort of if they're headed up and to the right, but is it just performance of the company, or how do you guys evaluate whether or not this is like really the CEO is focused on the right things and it's moving in the right direction?
Yeah, so I would say for us, it ties back to the operating plan that we put together. We call our portfolio growth plan. So coming out of those first 100 days, we've got a plan of 3 or 5 initiatives that we're going to focus on, and metrics that are specifically tied to those. So some of those may be, dollar-based. So bookings growth, among existing customers. We want to see that, increase 20% year over year. We can sort of track to that, but there's also other more sort of subtle metrics, things like if we want to double headcount capacity within our sales team. We have a hiring plan to hire 10 sales reps this year, and 2 in the first quarter, 3 in the second quarter. We will track against that, and so that sort of one pager, which is beyond just the typical financial package, we look at on a monthly frequency. So we have a sort of dedicated operating rhythm where we go through, not just quarterly in board meetings, but every month we go through and talk about the exact same things, the same topics, the same 3 to 5 things that we talked about when we first did the deal, and we look at the metrics and how we're tracking relative to really sort of objectively be able to say we're making progress here or we're not.
I think we do something similar, and we call ours kind of the one-page plan, but it's the one page of metrics, and some of them are financial performance, some of them are leading indicators, like what is, if you're building out your team, what's your employee net promoter score? Are your employees happy, feeling motivated, really engaged in the business? Because that's probably going to drive a lot of the financial results that come from the business. And so, we also look at a few key metrics and kind of track people to that and see how those are going.
Great. So Mark and Chris, if you could offer Jake and Haley any advice on being a good capital partner to you as a CEO, what would that advice be?
Mark, you want to take this one first?
Are things going well or not going well in the company?
How are things going at Little Sprouts?
Yeah, so I do think this is a little bit of personal style preference, so I'll just offer it as one person's opinion. But I actually have appreciated kind of focused attention from a narrower set of shareholders and the accountability that's come with that. So I've liked the greater attention to detail and shorter term results, and this idea of revisiting the strategic levers once a month, I think is very credible. I would say not, to go back to what Chris said earlier, not undermining your CEO by saying like, this is your decision, but here's the answer. That's not like particularly productive, and I do think this notion of like authentically empowering people is the right strategy.
Chris, anything to add?
No, but just kind of Mark did jog my thoughts on one area, which was that with the private equity firm, they have been a good partner. I think about the spectrum of PE, where if you have another software-focused private equity firm that's very prescriptive and it's our way or the highway, Excel KKR has been much more collaborative in general. But having someone that can, so I had 4 board members previously with the search fund. They're all different, independent from each other. And now I still have 4 board members, but they're all part of Excel KKR. So I only need to talk to one board member and trust that they'll share it. So Mark kind of made a point there that it is nice to be able to just communicate with less people and get the message across. So I would just encourage you guys to ensure that your portfolio companies have similar channels to communicate.
I have one other piece of advice for you two, not generally. So we had a board member who never a single time in the ownership period set foot on the property, and that struck me as less than ideal.
Show up.
Show up. Yeah.
Okay. Jake, Haley, your turn. Advice to Chris and Mark as CEOs with partners that have capital but also like to get operationally and strategically involved in their investments. How can they be a good partner to you?
So one thing I want to say to Mark's point, I totally agree with the empowerment with accountability mindset, and having, as a, whether it's the private equity sponsor or as the board, is sort of having that mentality when you interact with and work with the management teams. I think is important. The one thing I would say is where we seem to get, in instances where we can get sort of sideways with management or with the CEO, is when they don't necessarily know when to ask for help versus go at it alone. So, raising your hand earlier and saying, we've got a problem on the team, and we're going to need to take 3 to 6 months to change some people out, because this isn't going to be sustainable over the long term, or we need to fundamentally change the way that we go to market or sell this particular product, and we need to sort of hit the reset button, and you guys need to be aware of that, and I need to bring in some help, whether it's a third party additional capital, things like that. I think that's sort of knowing when to go at a loan versus asking for help is something I would encourage people to think about.
Yeah.
Definitely agree with that. And kind of another flavor of that, I think, is just leveraging the rest of the portfolio as well. So something unique about being a private equity firm, there might be 10 or 15 or 20 other portfolio companies that have gone through a similar life cycle that you're going through right now. And it's so helpful when people say, hey, we're thinking of changing out our GL, or we're thinking of migrating to this system. And as the private equity firm, we can say, well, actually, 2 of the other companies I work with just went through this. Would it be helpful for you to talk with their consultant that they used, or kind of hear how they thought about raising prices in this similar segment? So I think just leveraging kind of the shared knowledge is something that I know we don't do as much as we certainly could. And it's so helpful when we're just plugged into what's going on with the CEO and the company, and we're able to help in the most impactful way.
Okay, maybe that's a sign. Is that the mood lighting? All right, I think we've got time for like one more quick one before we open it up to the audience for questions. And because I've got a really interesting 50-50 split here between CEOs and operationally focused investors, I have to ask this question. So what matters more in the ultimate success or failure of an investment? Is it the asset and the industry that asset plays in, or is it the operator? Let's get into sort of the jockey or horse debate here for a second. And anyone who'd like to get us kicked off with their perspective on what matters more, the asset or the operator?
I mean, to respond to that, it's tough not to invoke the names Warren Buffett and then maybe a slightly lesser known but equally wise Bill Egan, which is...
In this room, he might be equally
Yeah, exactly, yeah, as he should be. So, I mean, I think their views, which I would have a hard time disputing, is that, when the tough industry meets the great CEO, it's the industry that leaves its reputation intact. So, for my part, I do think that it's... hate to say it as the jockey, but I think it's
well,
it's
you're showing your humility here, Mark.
Aha, there we go.
Yeah.
I would say, I would tend to say the asset, but with a caveat that, from our perspective, when we're buying businesses, an asset purchased at a reasonable price, which in software transactions these days is bonkers. So an asset bought at a reasonable price where you can make some money. But with that said, I will say having a really good, world-class sort of the 50 or 60 CEOs I've seen, the top quartile can take you from, for us, 2.5 to 3 times return to 4, and that's really significant. So it's a bit of a hedge, but they go hand in hand.
Sure.
Yeah, much like Mark, I hate to admit it, but I would say the asset over the jockey as well.
To play devil's advocate, I would love to think as an investor I create a lot of value, but I think the reality in the U.S. you can lose your money once, but you can make it back many times over. And I think we've just been amazed by what a powerful operator can do to even just a mediocre business and the life that they can inject into it. So I think the operator is still a very key part of a successful investment.
Great. From what I'm hearing is I think most of us agree with Warren and Bill, which is good company. So, but I appreciate the thoughts on the value that the operator plays in a fundamentally sound business. I think that I heard that from across the group. A fundamentally sound business bought at the right price. That's the starting point that a good operator needs, I think, to succeed. Robbie, are we good to open it up for questions? Okay, yeah.
During the life cycle of the business, is there a time when you start as capital provider start eyeing the exit? Are you doing anything or coaching the CEO or do anything so that you're ready to go and kind of shifting gears into the exit opportunity to CEOs who have exited? Do you feel any difference or do anything different in the last 18 to 24 months? The whole thing is fun.
A little longer.
I would say.
Yeah, sure. The question was around operating the business and how your mindset and mentality on operating that business may change as the end of a potential holding period might come closer into sight. Is that a fair? Yeah, okay.
I would say, so of the 6 portfolio companies we have today, half of the CEOs have prior experience going through a transaction or sale process. So for those folks, we probably wouldn't need as much care and feeding and sort of help as the other 3 who have never gone through it before. So for the folks who don't have experience going through it, 12 to 18 months out, we would start those discussions and sort of talk to them about the process. Where we typically, if there's any change, typically bring in a new CFO at the end of the investment when we're ready to exit, because there are some some things, having gone through a transaction as a CFO, that it really helps when you've got somebody in the seat who's done it before.
I had an amazing board member when I was an operator tell me, gave a great piece of advice, and it was very simple and straightforward, which is part of the reason why it was so great. David Dodson has a way of doing that to the entrepreneurs that he works with. But he said, run the business as if you're going to own it forever until you're not. And so your job as CEO is to really continue to foster employee relationships, customer relationships, and really drive that business forward. And I would say, I would take his comment a step further and say, you also need to continue to run the business as you're going through a sale process, because nothing kills a sale process like a missed month or quarter of financials. So you do absolutely need to continue to run the business and drive growth and profitability and achievement of budget. But run the business as if you're going to own it forever until maybe at the end there are some small things that you just need to be doing to sort of clean up the house for a potential capital event. Robbie, other questions? Yeah.
Mark, Chris, as new searchers in the past, as new CEOs, there's a lot of weight that ultimately gets put on your shoulders, whether it's being a first-time CEO or maybe going through a transaction. How did you go through those time periods? Did you leverage, a coach, mentors? Can you talk a little bit about that? Because I know there are a lot of type A, ambitious folks in the room, but then, even those types of folks need coaching and mentorship during these time periods.
And just to clarify, the time period you're asking about is leading up to the initial acquisition and like the short number of days thereafter. Is that? Yeah. Oh man, I was so stressed. I don't know. Do you want to?
Yeah. Well, I had my first kid shortly after we acquired the company, so that kind of compounded the stress. But I eventually got a CEO coach, which certainly helps. I mean, it's a sounding board outside of your board of directors to float things past, and then also reached out to other investors who weren't on the board just to kind of get some opinions there, especially other recently exited search fund operators that they'd been through it recently, and they were helpful in giving thoughts on whether it was an HR issue or maybe try this in sales or whatever. But just leveraging a wide range of people for helping that.
Yeah, a particularly helpful network for me at that time was investors that were not maybe going to take as much of the equity, so they weren't going to be involved in the board, but they were folks I developed a strong relationship with over the course of the search. And those felt like conversations I could be a little more raw and vulnerable at a time of significant stress. And then pretty quickly thereafter, I joined YPO and joined a forum within that organization, and that was a very helpful network for me thereafter.
Yeah, I joined YPO as well, and YPO is extremely helpful for people who can get into it.
Great.
Thank you.
Thanks for coming. What are some specific techniques that you used and found successful in motivating the workforce to increase output and efficiency when you came on board?
I've got a funny little sidebar story while you guys think about it. I thought that it would have been equity because that was what motivated me, and I went to Booth, and I'm sort of an economic creature. I tried to give some phantom sort of equity option shares that were frankly even confusing for a Booth or Kellogg grad to grasp the true sort of intrinsic value of, to one of my lead installers at the business that I ran. He didn't understand it. It didn't make him work any harder. It was frankly just muddying the waters of our sort of employment relationship. And so I quickly realized that that was a bad investment, and I signed him up for, he was a beer enthusiast, and I signed him up for a beer of the month, a craft beer of the month, and he like from that day forward, he never worked harder. I mean, it was truly amazing. So a subscription to a beer of the month club for one of my lead installers, that it was critical that he was engaged, showing up on time and executing. That was probably the best thing that I did for that installer group of employees, for sure. You guys have anything to add?
So I took it a step further, and I committed heresy within the search fund and private equity world and gave equity to all my employees, which was, I had a lot of struggle with some of my board members who were just very much against that. And I think it definitely motivated some, but certainly looking back, there were people who didn't value it at all, especially because we're an LLC, so their profits interested in an LLC, very confusing, just like phantom equity. But on the flip side, things that did work, just celebrating little wins. So hey, if we had a record month or record quarter, right? I had one of our graphic designers would put together a little banner, and we'd send it out through email so people would know some of the stats, cake or whatever, or something. Just to, again, to celebrate those little things that hey, things are going well, and let's recognize it.
So this may be stating the obvious, but I don't think it's an accident that both of the responses have been focused on sort of people motivation. So you asked about productivity and efficiency, which could be interpreted as like system and process or new technology or whatever. But I think the emphasis on people and incentivizing the kinds of behaviors you want is the most important lever to pull at all times in the ownership, but I think especially in the early days.
Sorry, can we get a microphone?
Hi, thanks. I am Iris. I am a searcher in Texas area in oil and gas. And I would like, this question is for the operators. Chris and Brian, thank you for being here. I'd like to know what piece of advice you will have known. I mean, what is it that you wish you would have known when you were a searcher and when you were an operator that would have made a difference for you?
When I'm asked this question, I give a lame response, so I'm sorry in advance. But it's just so true in my opinion, and it's cliche. So in business school and while I was searching, I think if somebody said like, hey, are people important to running a business? I would have said, yeah, like they're pretty important. But I don't think I fully internalized that it is all about people. Like period, full stop. Like in my opinion, running a business is all about the people that you surround yourself with and the way that you align interests. So I would have tried to better internalize that when I was searching, I think.
I would just say the skills you develop while you're searching, you're putting together a list of companies to reach out to, you're cold calling owners. Like, if you don't have a sales background, like that, I didn't realize that is fundamental sales training that's very applicable when you get into running a business, because that's one of the levers you're going to pull right away to try to grow the business. And then to Mark's point, certainly running a company, the people aspect, and even just having done this transaction, I've hired 4 executives since April. And 3 of them were replacements for previous executives, and 1 was net new. So it's constantly looking at, can we, is there someone to upgrade and get us from where we are today to where we want to be tomorrow?
Mark, could you speak a little bit about the key factors that accelerated your exit and the sale to private equity?
Yeah, you know how I said that the Jockey wins? So I just bought into a pretty average industry. So happily, actually, one of the investor groups represented here today helped me appreciate that fact early on, which was like fantastic. So, rather than kind of continue to try to push, this or fight this uphill battle, the reaction that we had, as a board, we decided the right thing to do is to try to go and secure an exit earlier rather than later. So I wish I could tell you that it was because there was some stroke of genius and we were really smart about it, but really it was more a recognition of the fact that it wasn't going to be like the world's greatest industry. Of course, coincidentally, now I'm still in it 4 years later, so I don't know what to make of that, but anyway.
Yeah.
As a follow-on to that question, with benefit of hindsight, what is there something you wish you would have looked at during, say, the search process in terms of understanding, is this a great industry, or is this an average industry? But again, with the benefit of hindsight, look at it before, thought it now, what would you advise in terms of?
Yeah. So a metric that I never really thought was very interesting that I now think is very interesting is revenue per employee. So don't buy one that's like $30,000 because the math doesn't work very well. So I would just say operating leverage, and for me, maybe not being in something quite as labor intensive the next time around. My business looks more like Chris or Brian's.
There are a few metrics that I use to evaluate operational complexity, and the lower the revenue per employee metric, I use that as one of a few proxies for operational complexity. Those are tricky businesses to run and grow and scale.
Where were you 6 years ago, dude? What'd be nice to know.
For me, it's just, there's a lot of capital in this industry already. So I bought into an industry that has a lot of competitors that are backed by VC or private equity firms, and it's a very competitive market. And I mean, we're fortunate that we had a good little niche that we're able to differentiate and grow and have a successful outcome, but it makes it really hard. So I would caution you going into an industry with, especially as it's shifting, more VC money coming in than anything else.
I think we've got time for maybe one more. Robbie, great. Yeah.
So, how long did your search process actually take? And how much did you kind of stray from your initial investment thesis?
So mine was the Stanford average of 18 months from closing the search fund to closing the acquisition. And software was a part of my kind of thesis. I looked at other non-software stuff, but that was core in my PPM originally.
So if Chris was average, I was below average. So mine was 28 months. And then, interestingly, I did raise my fund on the basis of an industry focus in education. But if you were to read my PPM from 2010, it would say, like, I will not do a bricks and mortar deal. I won't do a childcare deal. And then, sure enough, I did. So.
Please join me in thanking our panelists. Very insightful. I think that everyone, certainly I did, learned a lot from this conversation. So thank you. We know how busy you are. Thanks, everybody. We'll see you at lunch.